Okay, hey everyone. Thanks for joining us today. So today we're going to talk about a topic that every founder needs to know about. But if you are a first-time founder and you, particularly if you come from an engineering background, perhaps you're not necessarily going to know any of this stuff. And so, yeah, this is a sort of broad overview. If you have raised money before for a previous venture, or for this venture, in fact, then some of this is going to be kind of irrelevant. But there's probably something of interest in there. This is based on our experience helping, all of the, not all, but a large number of the other founders in the ecosystem raise capital over the last year. Seb's experience and Seb's experience as a COO at Techstars, which is a startup accelerator in Berlin, right? I think. COO there for 3 years, so saw about 45 companies go through this kind of process, and our own experiences over the last 4 years. So there's a broad background to it. Hopefully there's something of interest in here for everyone, but for the first-time founders, this is the absolute basics. So let's jump into that. This is the process that most companies go through in some form, and projects, of course, in the crypto space, when they want to raise capital. You don't have to stick to absolutely everything in this sort of formula, but there is a sort of good logic to most of it. So the first thing you want to do is you want to set a smart raising target. You want to work out how much capital it's going to cost you to get from where you are right now to the next useful milestone, essentially. And that's typically a milestone at which you expect that the valuation of your project is going to increase. And the reason for that is you want to make sure that you can essentially sell as little as possible of the project that you're building, so you can retain as much ownership as you can at the beginning. Yes, and get yourself to that stage where the valuation is going to be higher so that you don't have to sell quite so much in the next round as well. You don't want to have yourself sort of run out of money in between phases. This is sometimes, founders, sometimes founders, they think that, just raising a round number like 5 million or 10 million or whatever it happens to be is a good idea. We would generally caution against that. You should really focus on working out what it is that you need in order to get to the next phase where the valuation you would expect to take a large step up. And then from there, you can sort of, you probably want to multiply that number by 1.5 or something so that you have some breathing room. But that's the broad idea. It just round numbers, not so helpful necessarily. Just make sure that you can get to the next stage where the valuation is expected to rise. Get your cap table right. So I think we already had a discussion in this cohort of cap tables, but this is an important thing that you'll need before you can go to investors to raise money. One of the things they'll obviously want to know is, well, how much am I buying? And also, what are you going to do with the rest of the tokens in the system? Get your materials in order. So what you're going to need is a pitch deck of some form, typically to get the conversation started with investors. So something that an investor friend can send to someone else, say, hey, I'm looking at this interesting project. What do you think about it? Something like that. I think Seb is going to be running sessions, if he hasn't already, for you guys about how to build pitch decks and how to get that stuff in order. Prepare your docs and your legal structure. So this is the kind of other side of things. You need to make sure that you have some kind of sensible legal structure for your organization. Even if you're selling tokens, you'll need some kind of entity from which to sell those tokens. And where that entity is based, for example, is really important. Whether it's a foundation or a company is really important. Yes, and the relevant crypto-related regulation of that jurisdiction, and potentially the jurisdiction in which you sit as well, depending if they're different, and also depending on that jurisdiction. So those are all things that you want to talk to legal counsel about in one form or other. So, okay, you've got all of the preparation done. The first thing you need to do is to reach out to your first investors. This process, you generally want a warm introduction through someone that you know and is respected in the investor or VC circles that are interested in investing in the assets that you are selling. So in this case, crypto tokens. Yes, we're happy to provide some introductions to the projects in the Foundry to get you sort of on the map, if you will. But there are also many other ways of doing it. Getting your first soft commitments. So you speak to a few investors, and they're likely to say, "Yeah, I'm kind of interested in this." Speak a little bit more, and they'll say, "Okay, yeah, I think we can commit probably, around however much it is." So get to that point where they're sort of giving you an offer with stipulations potentially. So they're obviously expecting that other people will come into the round, and they're the first people you've spoken to. So they're kind of going to give you kind of soft yes, if you will. Don't expect them to be like, absolutely, I will sign the docs today. It's unlikely to happen. Explore the social graph. This is perhaps the most important step that founders don't realize when they get started, is that essentially, as soon as you have that first soft commitment from your first investor, the next thing to obviously follow up with is say, okay, great. Who else do you think would be interested in this? And have them forward the deal to their friends, essentially. And when they do so, you repeat the same process. So you talk to them, you explain the project that you're working on, and if they're interested, they will also soft commit. And then you do the exact same thing again, spider out to the next layer. And at this point, you shouldn't be taking firm commitments. So you shouldn't be allocating room in the round. You're just saying, okay, thanks for giving me this soft commitment. I'll come back to you when I know how things are looking like they'll play out. It's really important that you don't finalize the allocations early. And there might be some pressure to do so if the investors think that it'll be a particularly, competitive round for them to get into eventually. Then they might push you to, offer them a firm amount of the round. But you don't want to do that until you get right to the end. And then you can start to work out, so which of the investors that you thought might be the most helpful, and which of those that perhaps aren't going to be as helpful. And then you can start to allocate portions of the round that you've put together between those investors. And at this point, you have a sort of good understanding of, better understanding of the situation. So you can avoid the pitfalls of, over allocating early. Because of course, if you go to the first person that gives you a soft commitment, and you say, okay, sure, I'll give you, 20 or 30% of the round. By the time you're done, you might have found many, many other investors that you think will be really useful to your project. And you'll have to come back to them and say, well, either you'll have to honor this agreement you've made, which potentially, it disadvantages your project going forward, or you'll have to ask them politely, can we move it down? And that will be an upsetting situation from their point of view. So you'll lose friends doing that way. Don't. It's not a good idea. Only make the allocations once you have all of the soft commitments from the investor side on the table. Okay, confirm the commitments once you've sort of allocated the capital from your point of view. So you've got a spreadsheet basically that says, okay, we think we give this amount to this investor, and so on, until the whole thing is full. And now you go to each investor and you say, hi, thanks so much for your interest in the round. Things have become, if you're at this point, things have become, much more exciting and fast-paced in the time between, because of course, when you go to that first investor, things are going very slowly. But by the time you're finished with that exponential process of exploring the social graph, and of course, the investors will be doing this whether you ask for their help or not, because investing is, at least at the venture capital stage, is a very, very social game. It's like everybody's interested in what everyone else is investing in, so they're all talking to each other. And by the time you get to the end, typically, there's like a fervor around the round in some form. There's lots and lots of people talking about it. So you go back to the original people and you say, hey, things have sped up a lot since then. Would you be comfortable taking this quantity? And then you do that for everyone. You confirm that they are happy with the allocation that they've received. And you might have to, negotiate this a little bit. So take a little from one, put it in another, and so on. But eventually you confirm those commitments and you have a hard cap table for the round. Send the documentation. Typically, people use DocuSign for this. Just make write-in slots in the right places. Just send it out. Receive the money and then get back to shipping. That is essentially the whole process of fundraising for most startups, whether they be in crypto or actually equity-based startups. This is the broad outline of what you need to do in order to make it work. Now, some kind of realities that the founders don't necessarily realize when they are getting into this in the first place. So big numbers are generally bad. Taking more capital than necessary is almost always bad for founders. And the reason for this is quite simple. When you take more money than you need, you have to sell more of the ownership stake of the thing that you're building than you need. And doing so, means that you don't have it later, right? And so as you accrue value to this thing, so remember, you're working day and night to make this thing successful. And if you own 20% different amount of it, then that's actually a huge change to the to the outcome that you'll eventually receive for your work. And the other side of this is, okay, so what if things don't go well? What if things go poorly? Well, then better that you didn't have so much capital and it didn't go well than if you had too much. And that's true on two fronts, because one is that in the future, if you ever want to raise money again for a new venture, taking more capital and not having a successful outcome will not be a good thing. And on the other side, there's actually, every dollar is associated with some quantity of expectation, both, on the soft side as well as the financial side. So every dollar, everyone would expect it would go proportionally up. That's what we all want, right? But also on the soft side, there'll be more expectation of contact and so on. And so that can actually just eat up time, essentially. So raising large amounts is, when it is not necessary, is not a good idea. It can also just, those things alone, really that just expectation game and the circus around investing can really screw up projects that would be otherwise good just by raising too much. It is really a big pitfall. So this is often a big surprise to engineering type founders, I think. But post fundraising, you should expect to spend around 25 to 35% of your time on investor relations, much more in bear markets. And that is a cost you must take into account. It's not just that you are selling ownership in order to gain capital. It's that you are selling ownership and access to your future time in order to gain capital. And so this is actually quite important we see a lot of founders in the ecosystem are the core developer of their project. And I'm sure most of you in the Foundry are this way. You got to factor in that your time is going to be taken by other things now. And so you'll need to hire to help you cover it. And so this is actually a major hidden cost with raising capital in the first place. I always sort of encourage founders to take very, very small amounts of capital, maybe just like a few what we call angel investments. So investments ahead of a large round, just very, very small amounts in the early phases so that they can then focus their time on building until the point where they want to scale up and build out a bigger team. Like if you can get to the point where you have reasonable product in the market before fundraising, then that can be a good thing if you are that kind of core developer type founder. Yes, investors tend to be purely rational actors economically. That is sort of sounds like it stands to reason, but you need to carefully assess and analyze how that fits with your motivations for the project that you're starting. You might find that what do you say? you might find that actually your motivations are partially economic and partially to achieve something in the world. You got to realize that from an investor's point of view, achieving something in the world is a nice to have, and I think most VCs, at least I know well, they're all fairly idealistic people in the same way that founders are, but they're also under their own set of pressures, often from less idealistic people who are the limited partners in their funds. The people that have given their funds money have put pressures upon them to simply return a high yield. That is simply their job at the end of the day. And you've just got to be careful that you're not going to find that this is too distant from your motivations and it causes you problems down the line. So just be careful with that. All of this said, the obvious is still very much true. Like investors in the venture capital landscape particularly will lend you the capital you need to build the things that you dreamed about. This is a life-changing event for many people that start companies. So it's pretty amazing in that regard. So, misunderstandings about the process. Sometimes we see founders in the space who are, I would say, overly deferential to investors, calling investors sir and the likes, and understanding this as some kind of favor. That is not the case at all. What you're building is potentially, and if investors are looking at it very seriously, then quite likely to become a highly valuable project. Investors raise funds, particularly venture capital. This is in the venture capital space. They would raise a fund and they would say to people, okay, I'm going to deploy capital, all of this capital that you give me over 4-5 years maybe. And that is their job. It's not a favor. They're sort of contractually obliged to do this. So you need to work in a sort of respectful and cooperative way, but don't imagine that they're doing you a favor. It's not true at all. Actually, you're likely or potentially selling them ownership of something that you're going to spend a long time making very, very valuable, and it could be worth hundreds or thousands or even more, I guess, at times more later than they are buying it from you now. And so, just keep that in mind. Be kind of respectful and polite and reciprocal, but don't think that they're doing you a favor. It's not the way that the system works. In crypto, VC, venture capitalist, doesn't really necessarily mean long-term. In fact, actually, because of how the incentives work, funds simply have to return the capital with, ideally, a large amount extra to their limited partners within some time frame. Yes, it doesn't necessarily mean that they'll be associated with your project for a long period of time. And in crypto, tokens tend to become liquid much, much earlier in the process of a startup's life, essentially. And so there is always an incentive when the prices are extremely high for VCs, whether they be theoretically long-term or not, to sell some and to realize some of the gain that they've made. It's almost, what would you say, a fiduciary responsibility to do so sometimes, particularly when there's like a crypto cycle like we're seeing now. So you've got to understand that you're not necessarily going to have the same relationship that you would have with VCs in the equity world, where you're both tied together in a ship. There is no liquidity for a very long period of time, and there's kind of a 90% death rate before you get to the point where there's a liquidity event one way or another. So it's really a tight relationship. That's probably not what you're going to have in the crypto space, because there's just early liquidity, and so you might find that your incentives aren't necessarily aligned with VCs as much as they would be in the equity space. You might be incentivized around a sort of 10, 15-year time horizon, maybe for your project, or 5 years at least. Whereas they might be incentivized around, like 18 months to 3 years, and that would be on the longer term end in in crypto. So just be aware of that. Okay. Another misconception is that speculators on token price are a community. That doesn't seem to be true as far as I can tell. Contributors to your project are your community. This is actually different depending on, from project to project, I suppose. So there are some projects, for example, if you're building a, what do you call it, a kind of a mass consumer social network or something like this, then the community are, with Web3 economics, say, the community are likely to be just your user base. And maybe some of them might speculate a little bit. But mostly, you'll find that the community are just people that are really passionate about your idea, and they want to speak about and contribute to that idea. Speculators often call themselves community members in the crypto space, but in general, they can have useful short-term price implications for your project if that's something that you want. But other than that, they tend to be very loud and very demanding of your time and attention. So they'll try and encourage you to do things that will pump the token price in a very short period of time. And that's not necessarily something that is a sensible long-term decision for your project. So just be really wary about that. I think over the years, at Arweave, we've come to kind of really just focus on contributors as community members. And it works quite well for us now, but it took a long time for us to work out how to deal with this situation, because frankly, it's new. In the Web 2 space, when you have an early stage startup, you have a very small number of investors in a project typically, and that you spend with your investor relations time, as I described earlier, you handle those relationships, but you don't have a sort of mass of people speculating on the token price in the short term during the earliest phases of a startup. It's highly unusual. It really didn't used to happen at all. But now it does. And so you need to work out new ways of dealing with it. There are lots of different philosophies in this area, but certainly I would just recommend thinking about it at the minimum upfront, and working out how you're going to deal with the fact that there's this new liquidity, this new set of circumstances created by the liquidity of the tokens, the early liquidity of the assets associated with the startups. One way you can get around this, of course, is to simply sell privately to large venture capital-like investors. But that only gets you so far because, of course, it's being crypto. People expect early liquidity. And going back to that question around the long-term incentive alignment between you and your investors, realistically, some of those investors will want you to list your token or have your token be liquid one way or another within some relatively short time period. And that will mean that eventually you will have speculators that sort of claim to be community. So just be aware of that. Okay, broad-based tips. Don't trust, enforce with lockups. This goes back to the long-term incentives question. Even if you are really excited to work with an investor and you think they're going to be a great long-term partner for you and the project going forward, just make sure that you codify your lockups in the contract itself. Don't leave it to chance, because the incentives on investors, they change too. Maybe they've got limited partners that are excited by the bull markets that we're in right now, bull market phase that we're in right now. That might mean that they want to sell some earlier, or they have, there's a whole bunch of different ways they can think about it, and that might change, would you say, your experience of working with them over the time periods that you're thinking of doing so. And early liquidity really sort of, it's a curveball, right? And just increases the likelihood of chaos, if you will. So just enforce the lockups that you want and you've agreed upon in your contracts. And for what it's worth, this should also go for you and other team members. Make sure that you lock your tokens. There's an interesting story, I don't know how true it is, but apparently the Ethereum core team had no lockups for their tokens at the beginning. And now, what do you know? And they had like 7 co-founders or something like this. And what do you know? Like most of them left, and now they're building other startups that aren't in the Ethereum ecosystem even, apart from Consensus, I suppose. But things like Cardano, Polkadot, so on. Yeah, because why not? Like there's no incentive for them to stay attached to the project over the long term. So make sure that your tokens are locked in. We discussed this, I think, in a previous call. Something like 25% per year with a 1-year cliff is typical. But I think like a 5-year, 20% per year is also reasonable too, for both sides, both you and investors and other participants in the project. Okay, when you speak to investors, show passion for your project. Like ultimately at the earliest stages, they're likely buying into you as people and what you are likely to be able to build. Because realistically in the startup world, one does not start with an idea and simply go and execute on the idea and find that it perfectly has product market fit and everything is perfect from the beginning. It just doesn't work like that. Instead, you have to kind of feel around in the darkness and try and find that niche that your product can fit into, and recarve the product and maybe pivot the idea completely. We've seen this a few times in the Arweave ecosystem recently, but of course it's happened everywhere. Like Twitter, I think, started as was it Twitter or Figma that started as a drone company? But either way, in the startup world, pivoting is a fairly normal thing to do until you find the right niche that you want to go into. Yes, and so for investors to have confidence in the project, they really need to have confidence in you and that you have the desire and passion to build this thing. So make sure that you put that on display when you speak to investors. Show that you understand that your tokens are valuable and demonstrate that they're scarce. Don't be overly giving, if you will, of the tokens. Many investors will, typically, frankly, less sophisticated investors will ask for advisory tokens as well. Don't be too kind. Just be polite, of course, but don't give things away unnecessarily. Show that the tokens are valuable to you, and realize that this journey that you're on has a higher likelihood of success perhaps than you expect. And so each token that you give away is a token that you don't have in the future, and that will hurt you. So just kind of demonstrate their scarcity in your mindset, if you will. This is a funny one, but know how you will start a conversation with a new investor. This is one I got from a VC friend of mine. They described this process that the founders would come to them and they would get on a call, or they would meet in person, and there's this very uncomfortable, awkward start of a conversation where no one really knows what to say. So they're saying, I guess you could tell me about the project. And then it kind of gets into it, but it's uncomfortable. Just know how you're going to start the conversation. And this is actually a simple thing to do, I think. Simply when you get on the call, just start talking about, hopefully your life as a founder is going to become very exciting and interesting. And all of the things you do every day will be kind of that way for you, exciting and interesting. So just start talking to them about what is new and what you've been working on, just like literally right before the call. And a little bit of good news doesn't hurt in that kind of opening section. And then from there you'll get into let's talk about the project from the beginning, and then it'll be a good conversation with nice, comfortable vibes on both sides. Don't let it just sit awkwardly and uncomfortably to begin with. This is probably the most important thing to learn from this presentation, I think. But ask for references from other founders about what it's like to actually work with the investors you're thinking of taking on. This is critical because there's sort of this underground network, if you will, between founders about what their experiences have been working with VCs. And the thing is, from the VC side, access to the best deals is one of the, I guess, I was going to say two, but maybe there's more to it than that. But one of the top priorities. and how you do this is brand. But of course, brand isn't necessarily reality. Whereas if you speak to other founders about what their experiences working with these investors were like, then you might get a very different picture. So I would really strongly advise you to do this every single time. Don't just let your instinct guide you without confirming with others. And also, it's a great way to meet other founders that might want to use integrate your project into their system, or just to chat. Like it's a good thing to do anyway. Finally, I think treat investors as peers that they are. You're all working together to make this thing successful. Don't be, as I described, overly deferential, and also don't be a jerk. just work together with them. This can, I think, be difficult for some first-time founders to work out like where the lines are here. We've definitely seen this with a few founders in the Arweave ecosystem. But yeah, just you'll work it out over time, but just treat them as you would any other kind of teammate, essentially. And from there, everything should kind of flow reasonably. But as described earlier, enforce lockups. Don't expect that part will come for free. All right, thank you, everyone. Hopefully that was helpful. Let's jump to the break room and discuss.